Hi all, greetings to everyone. Welcome back to Samsware, your weekly compliance tracker. We are Samsware Advisory Private Limited, a one-stop shop solution for all of your compliance needs. As promised, we are back with the weekly updates related to global compliance. Before we proceed, let me remind you all to click on the bell icon below to never miss out on any regulatory update that might affect you as a business entity. Let's proceed with our headlines for this week. Malaysia publishes amended guidelines on taxation of e-commerce transactions. The Malaysian Inland Revenue Board, acronymized as the IRB, has published the amended guidelines on taxation of e-commerce transactions, replacing the existing guidelines dated January 1st, 2013. The key terms that are defined under the amended guidelines include e-commerce transaction. An e-commerce transaction is defined as any sale of goods or services over any networks by methods specifically designed for receiving or placing orders. Digital currency. Digital currency has been defined as a digital representation of value which is recorded on a distributed digital ledger, whether cryptographically secured or otherwise, that functions as a medium of exchange and is interchangeable with any money, including through the crediting or debiting of an account. Digital token. Digital token has been defined as a digital representation which is recorded on a distributed digital ledger, whether cryptographically secured or otherwise. The guidelines have also enumerated a list of business models that would be considered e-commerce business models, which includes online trading or service providers, app stores, online advertising, cloud computing, payment services, digital currency, or token. It has to be noted that any income in relation to e-commerce transaction is deemed to be derived from Malaysia if it is associated to any activity in Malaysia, regardless of whether that income is received in Malaysia or otherwise. The Australian Taxation Office finalized another ruling affecting cross-border finance, confirming the Australian Taxation Office's views on what types of costs are debt deductions that are subject to the thin capitalization. Interest expense being the largest component of debt financing that can be caught within the Australian thin capitalization regime, there are other costs that are associated with debt financing that may be caught within the Australian thin capitalization regime. Under the thin capitalization rules, a taxpayer needs to work out his adjusted average debt, which includes all debt that gives rise to debt deductions. If it is found that this adjusted average debt is higher than the maximum allowable debt, then a proportion of debt deductions are denied as a deduction. In addition to usual interest, a debt deduction includes a cost that is any amount directly incurred in obtaining or maintaining the financial benefit received or to be received by the entity under the scheme giving rise to a debt interest. Reintroduction of the bill proposing to make directors personally liable for companies' GST in Australia. The Treasury Laws Amendment Combating Illegal Phoenixing Bill 2019 proposes to allow the Australian Tax Office to make, in certain circumstances, directors personally liable for their company's goods and services tax liabilities, and to collect estimates of anticipated GST liabilities when remittances and filings have not been made. The complex provisions contained in GST law give rise to legitimate disputes over the existence of a GST liability. With the introduction of penalty notices for GST liabilities to directors, it has been anticipated that it is likely to encourage directors to take conservative positions and alternative positions may be supportable under the law. Saudi Arabia amends VAT Regulations. Saudi Arabia recently published the value-added tax implementing regulations in the official gazette. The amendments have both technical and administrative implications with respect to Saudi Arabia's VAT rules. The key changes are introduction of instances where the zero-rated VAT does not apply to an exported service, provision of guarantee by non-resident taxable persons without a tax representative for Saudi Arabia VAT purposes for an amount determined by the General Authority of Zakat and Tax, appointment of a third party by non-resident taxable persons who do not have a tax representative for the storage and maintenance of their VAT-related records in Saudi Arabia. Appointment of a local tax representative by a non-resident taxable person is now optional. Publication of new AML regulatory technical standards that apply specifically to credit and financial institutions by the European Commission. The European Commission has published new regulatory technical standards that apply specifically to credit and financial institutions, including e-money institutions, payment institutions, and investment firms. The new standards specify additional measures in respect of relevant institutions, branches, and majority-owned subsidiaries, hereinafter referred to as local entities operating outside the EEA. The local entities will now have to review AML or CTF risk in all non-EEA countries in which they have local entities in order to identify those jurisdictions which have requirements that are less stringent than their home member EEA state. Take mitigating actions to reflect the restrictions or different standards applicable in those non-EEA countries. Notify their home state regulator. The implementation deadline of 3rd September 2019 is now less than 3 months away. That's it for today. I request you all to like and share our content. Feel free to comment below with any queries that you may have related to compliance. We will do our best to solve them. You may also contact us through our Twitter handle, Facebook page, LinkedIn page, or our website. Links in the description below. Until next Tuesday then. Thank you.